In this example, I will particularly discuss with you bank statement reconciliation. So the usage of the banks is very important because of the bank, we don't have as much currency usually on hand. That's why you usually even have not direct deposit, the deposit box outside of the bank. In the mall, sometimes it's like a box in the wall that looks weird, but they do it on purpose. So then specific store will not have too much cash on hand at any time. They just basically deposit it even sometimes throughout the day. We have a double record of bank transaction, us and the bank. And then bank reconciliation is a perfect example of independent internal verification. Let's take a particular look at a bank statement. It might be very much like the one you get from the bank. I would say pull up yours and see and compare. So for example, what are the primary features there? You will have a balance as of last statement and the balance this statement. You will have total deposits, and it says credits. Why? Because it's from the bank perspective. So for them, credits are good and debits are not so good. So the other way around, it's almost like our loans are actually assets to the bank. I'm not too worried about these totals, but we do need the extra information that is provided there, because it will give you, first of all, a list of all the checks that cleared the bank, and then the amounts. We will need that. And then extra information here, such as credit or debit memo. Again, don't worry about the words debit and credit because they're backwards for you versus the bank. But there might be some error corrections, EFT or electronic funds transfers. NSF, what's NSF? Non-sufficient funds. So NSF was either returned because somebody did not have enough cash or funds in their account as you try to deposit somebody's check. We'll see that. Okay, so bank statement. I already pretty much covered all of these. I'm going to go directly to the bank statement. If I look at the bank statement and if you open your checkbook, there's a very good, there's almost 100% chance the amounts will be different. Why? There's several possibilities for that. You could have a time lag. So for example, bank statement was as of the end of the month. They mailed it. By the time mail arrives, they're already 2 or 3 days behind. So your checkbook could be 3 days ahead. Okay, so because of those time lags, you could have deposits in transit. So I deposited, I wrote it in the checkbook, the bank doesn't have a clue. On the other hand, I could have outstanding checks. These are even more popular because I could write a check, give it to somebody, and it's still at that person's purse, so they never cashed it. The bank is not aware that you already spent the money, so they have not updated for that amount yet. You can have all kinds of bank memos, so other transactions that you are not aware on the bank's side, and you can have errors. So errors are not as popular because we do have a lot of stuff automated. So this is the basic snap picture of reconciliation of the bank account, so we could come without true or corrected balance. I kind of almost call it, in the newspaper they put pictures and they would say, here's 2 pictures. They're almost identical, but there are 5 differences between them. So you will look at each picture and then figure out what the differences are. That's very similar to this. So for example, on the bank side, you would write a cash balance per bank, okay, from the bank statement, and then you will add deposit in transit. Why? Because we truly already made the deposit, right? It just has not been reflected by the bank yet. And you will subtract outstanding checks because I already wrote them and I already counted them in my cash balance per books. Again, the bank is just not aware of them. But it doesn't mean I could spend cash again. It's already been spent. And you can have bank errors. Unfortunately, with bank errors, plus minuses, depending on the error, it could go both ways. Let's look on the other side, cash balance per books. And you can do the bank statement reconciliation side by side like it's done here, or you can do cash balance per bank or per books first and then do the second part right underneath. So either way is fine. What else? Cash balance per books. You could have electronic funds deposit collections, so you will see them on the bank statement, but you were not aware that they happen. So you're going to go ahead and deposit them. Kind of very similar to deposit in transits. What else? We will not, in the problems, write NSF or not sufficient funds checks or bounce checks, but we could assume that our clients could. So what could happen? My client went ahead and wrote a check. I was all excited. I deposited it. I thought I deposited cash, and then I got the bank statement with this check marked as NSF. So I will have to take that amount out of my cash because in fact it was not covered. I don't have cash. That's why it's subtracted. Then I could also have service charges and other payments with a minus. So the bank could charge me for an ATM fees. Maybe you drove through somewhere out of town and here's $2 you had to pay. Or maybe it's check printing charges. Or maybe you have a safety deposit box in the bank and they charge you $25. Or maybe it's another $5 fee because you're below a certain limit. So it could be things like that. And again, you could have your own errors. So you could have written a check wrong the amount. Maybe the check was for $100. In your checkbook you wrote for $150. Or it happened to me once, I had a flu, so as I wrote the checks, instead of subtracting them from my cash balance, I started adding them. Oops. So, and then I ended up with the bounce checks and I couldn't figure out why. So don't get a flu or you might be in trouble. I will go ahead and do another video to illustrate bank statement reconciliation, and we will pick it up from this one.